I don't think I saw much.
He doesn't do steps.
And
So-
what kind of a problem is that for you? Down to the bedroom? Because she's in the room with you?
Yeah, so first thing in the morning, last thing at night.
Yeah. So you guys carry her?
No, you guys or me.
Yeah. You have a delegated that? Your family member?
So the family member in the hospital, that's like calling my son to come over at 9:30 at night. Hey, dude.
It's nice that Beth helped out with the golf outing.
Yeah, she
You know,
enjoyed it.
but I'll say howdy, haven't seen her in a long time.
She's helping out with the pantry rate.
Is she?
She's doing a lot. But she's on their board, but she's volunteered for committees for this Thanksgiving distribution.
Yeah,
So
I guess we'll soon be hearing about what we're gonna do around Thanksgiving. No, it's for donating gifts for the food drive.
I don't want them to sneak something in surreptitiously, and this thing passes in New York, and my daughter can make it
All that there.
10 or 12 years old without me knowing.
Everyone's muted. I
Our laptops now.
know, I do that kind.
Good morning to all the Zoom participants. We're about ready to get the show going here.
It's great to see a good crowd here this morning after our late night last night. I guess it wasn't too late, but a good evening last night. So thank you for all being here this morning. If you would, please join me in the pledge of the flag.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. May all be seated. We have one greeter here this morning, and I see he's making his way from way, way far in the back corner of the room. So Pete, would you be willing to announce any guests and visitors that we have this morning?
Yes, we have no visitors. We have one guest, and that is the speaker, Alex Snyder, son of Jeffrey Snyder.
Everybody, if you would, please, let's give Alex a nice warm welcome.
Welcome out.
Pete, I see you're ready to do.
6785.
6785. Diane. check my tape.
When I. Are they? You're 56 and 57.
What was it, Pete?
789.
785.
785.
785. Don Wonders? No. Come on, somebody has to win.
6785.
Tim Kohler, are you a winner?
Yeah, but it's not a drill.
He won, he got both the drills last night at the Polio Plus event.
Right, Tim. You want to start off any happy dollars?
Sure, absolutely.
I thought you might.
And all these happy dollars, they $15, $16 here. I'll make an announcement as well.
Why don't you take the mic?
I want to thank everyone for helping last night, especially Wendy and Nate. It looks like Nate was out a little bit later at the club. He didn't make it this morning. And so a general result of last night, gross was $7,800. And we have about $500 or $600 of the expenses, so a little over $7,000 net, which is about the same as last year. So that was a really great evening. Also, a special thanks to people who helped last night. Chris and her husband Dave sold the 50/50 tickets and worked the door. We had Diane helped with the tallying and using the credit card to all of our expenses. Of course, Greg and Elizabeth for doing the speeches and announcements during the evening. And Wendy's husband and her friend Dave helped set up, so it was really great. So we bring family and friends in to help the club. So thank you, everyone, and I appreciate everyone's help.
And thank you, Tim, for organizing a great event, another great event. So, anyone else for own happy dollars? Anybody else with happy dollars? Freedom. I'm gonna give you the mic.
Hey, well, last night was unbelievable. How our group has worked is beyond anything. So thank you for the group's work, and a special thank you for Roger to be here with us. Good morning, Roger.
It is good. I told Roger it's good to see him 2 days in a row. I saw him last night, and again this morning. So, I told him the same thing. Anyone else? Any other happy dollars? Morgan.
Okay. Last Tuesday, Raj and I journeyed up to Cortland, New York, where we lived for 23 years, south of Syracuse. And I was giving presentations on the Zambia humanitarian mission to the Rotary Club of Cortland and also to a Cornell University club. And it was so well received. They loved the photographs. And at the end, I had a standing ovation. It was not for me. It was for the fact that over 3,200 people were seen in 6 days while we were there. And people had so many good questions. Some people want to go with us now, which is great. We have the president of one club who is a retired teacher. She's gung-ho. And some people spoke of offering money for the grant. So just a big success that day. Loved it and came away feeling so good.
So, I understand that these clubs help with the mission, the most recent mission. That's how
Okay, thank
you
you.
connected with them.
No, they did not. I was going to speak to Cornell University Club, and they had some members that were also in Rotary, and they said, "Can you come to us too?" But well, why not? We got all the equipment, we're on the road. So that's how that happened. No, this is the first time they were really exposed to that humanitarian mission, and they had not engaged in one, and they were all interested with questions and still answering questions about how to go about it. Thank you.
I had $5 happy for Jim Norton for buying a lady
Jim, do we need any more explanation on that? Anybody else? Any other happy dollars? Okay, very good. Announcements. Jim Norton, you have to have one.
Really don't, although we need stuffing for the next two meetings.
Stuffing.
Stuffing. So I'm gonna help Jim Norton out, because I think he got sidetracked on an announcement about buying a lady a drink. So we do need, or we would like, if members can, help out with, Catholic Harvest Food Pantry's food distribution, Thanksgiving distribution. You all know, we do it every single year. What Chris and Catholic Harvest really need are, boxes of stuffing. And they are planning to do 2,300 meals. So I don't know how many, Chris, you've received so far, but figure we need 2,300, or they would like to have 2,300 boxes of stuffing to be able to put in with the meal that is given out. And we probably have, the next 2 weeks to be able to bring that in. So in the next 2 weeks, if you're able to bring in boxes of stuffing, that's great. If you want to just give a financial contribution, that can be fine. Chris will do shopping for that. So in any way, shape, or form that we can help out, it's hard to believe that we're talking about Thanksgiving already, but it's right around the corner. So, Chris, you want to add on to that?
In addition to needing 2,300 boxes of stuffing, I'm also looking for people to deliver meals. I have approximately 40% of our registrations that ask for a delivery. Most of them are either homebound, senior citizens, kind of earn the right, don't have transportation of their own. So if anybody's interested in volunteering, it's a great family event. The rule of thumb is a delivery team is 2 adults and as many kids that'll fit in the car, along with food and turkey for 8 to 10 families. And we'll give you a step-by-step route. It's Saturday, November 23rd or Sunday, November 24th, and go to yorkgiving.com to get the sign up information. There's a volunteer tab that you can just press. So thank you.
Super, thanks, Chris. I'm going to keep on with Jim Norton or announcements for club service. This month we have 5 Tuesdays and 5 Wednesdays. So if anyone is able to help with Our Daily Bread, whatever the date is, the last Tuesday of the 29th, or with Catholic Harvest Food Pantry and their food distribution on the 30th, we'll send an email out.
I was gonna say, I'll send an email out.
Yeah, but that's coming up quite quickly, so just keep that in mind. Anyone else, any other announcements? No? Perfect. If not, well, before we have our speaker come forward, Jeff Snyder's been teasing us that there's a mystery speaker next week. And I asked him and he asked for a bigger room. He wanted to have our meeting in the ballroom. And unfortunately, the floor is getting replaced in the ballroom, so that's out. So I thought, well, maybe we can meet over in the terrace. Well, they said they're having a blood drive that starts at 10 and they wouldn't be able to get us out by the time they have to do that, blah, blah, blah. So we're kind of stuck down here. But I said to Jeff, like, can you tell me, give me a hint on why we need a bigger room? He said, nope. So next week we will be meeting down here. I mean, we have this big area that's here. I asked Jeff this morning, is that going to suffice? And he said, yep, we'll make that work. But I have no other clue other than we have a mystery speaker next week. So come and find out what it is that he has hidden and what surprise he has for us. But now at this time, I'm going to invite Jeff to come forward and introduce our speaker for this one.
Thanks, Drake. My son Alex is going to be our speaker today, but before I introduce him, when Alex was in college, he worked 2 summers at Shiloh Nurseries digging ponds and laying stone walls, and he'd come home every night just totally beat. And I would say, how was work today? And he said, well, work was okay, but I work for this real son of a bitch. But working for this real son of a bitch. I never knew who the son of a bitch was until today, when we walked in and Alex walked up to Greg Kern, who was Alex's boss at Shiloh University 20+ years ago. So Greg, sorry about that.
He said, thank you for giving.
Yeah, I'm sure. In any case, Tony Wilson talks about speakers and, there's an old saying in life, you can avoid everything except death and taxes. So my son Alex is a tax and estate attorney with Barley Snyder in New York. He's been practicing for about 20 years. And I thought with some of the tax changes coming up next year, and of course, we're getting close to tax season, I'd ask him to talk briefly with us about some things that pertain to everyone's taxes. And fortunately, Hunter's here because Hunter can fact check him if he says anything that's incorrect. And with that, Alex, would you like to come up? Everyone. Good morning. Can you hear me okay?
Yeah.
And Greg was a great boss. He was really nice when I worked at Shiloh, although last day of work, we had a tradition there where you bring a case of beer in and everyone would drink together. And when I brought my case of beer in on my last day of work before I went back to college, we got back from working and the designers in the office had already taken the beer and dragged it off. That's a true story. So I appreciate you all being here on a Tuesday morning for the depressing topic of death taxes for the business owner. This is a topic that a lot of folks know a little bit about. You hear a lot about it this time, when you have a presidential election, or at least some people do that worry about tax stuff. So I thought I'd just give kind of an overview of this. Happy to answer any questions. I think I probably know where a lot of folks stand politically, but no political commentaries intended here. But there are some notes here that stray that way. So let's see. So sorry, Hunter.
We haven't plugged in.
Did you hit slideshow?
Yeah. Put it up there. I can give you a cue or something. No, there we go.
That's you. Yeah, it's you doing it.
All right.
Good.
Thank you, Hunter. Yeah. Appreciate it.
It just took a minute.
All right. So, when somebody passes away in Pennsylvania, there are 2 sets of taxes, possibly 3. We won't talk much about the third, but federal state tax may apply. That's a 40% tax, extremely stiff, very unpopular for folks who have to pay it, but it applies above a threshold, and I'll talk about the threshold in a minute. There's no transfers between husband and wife, but anyone beyond that, there are. Of course, charities aren't taxed. There's a deduction for that. Then there's Pennsylvania inheritance tax. And I say maybe because, again, it doesn't apply to transfers between spouses. There are some exemptions. There's that one of the few things that the state legislature has done recently that helps here. Well, they've done quite a bit with transfer tax, but there's some exemptions for farms and businesses that came around in the last, I'd say, 15 years or so. But there's no threshold when the tax applies. It applies almost $1. Now, the tax rates depend on the relationship between the person who died and the beneficiary. So again, husband and wife is 0. Children, grandchildren, great-grandchildren, or parents is 4.5%. Siblings is 12%, and everybody else is 15%. So anywhere from your niece and nephew to your next door neighbor, tax at 15%. So that gets to be pretty stiff if it applies, something to be aware of. Now, why are these taxes controversial? I mean, no one likes paying taxes. But you hear a lot about this, again, sometimes with the presidential election. The first point, this money's already been taxed. I agree that it's to have, you already paid income tax on these dollars. And then when you pass away, if the taxes apply, you're paying tax again.
that's a pretty hard thing to swallow if you have to pay that tax. Breaking up farms and businesses, that doesn't happen very often. If you can navigate some of the exemptions that are there, I'll explain that in a bit here, but that doesn't happen too often. The wealthy don't pay their fair share. Again, if your money's already been taxed, when you pay income tax, and then you're getting a 40% tax on top of that threshold, I mean, that's a pretty hard thing to swallow. Now, I think this ends up being a political football. The federal government doesn't make that much money off of a state tax. It's just something that gets batted around. Republicans would like to get rid of it altogether. I don't know that they're going to be successful in doing that. I don't, right now, the law's about as favorable as I've ever seen it. When I started practicing, the thresholds were a lot lower. Again, I'll talk more about that in a minute. The Democrats would like to reduce the threshold to about 3.5 million. So if you have assets in excess of that, you're going to pay tax. Now, I remember growing up, if somebody had a Mercedes or if somebody had $1 million, you considered that person an extremely wealthy person. And you didn't, that wasn't that long ago. Nowadays, if you have a couple $1 million, you might have retirement accounts, a house, some life insurance that's in your name. That kind of puts you close to that threshold where it might apply. So right now, again, I'll talk about the limits, but the taxes are pretty favorable for the time being. So when we talk about federal estate tax, you have to think about that in the context of it's really the amount that you can give away while you're living or at your death. So gift tax is kind of just the other end of the or side of the coin. It's also 40% tax in excess of your threshold. So you have a certain amount right now, 13.61 million that you can give away while you're living. If you go over that amount while you're living, you pay gift tax. If you've used up, say, half of that amount while you're living, every year that you exceed the annual amount, I'll talk about that in a second, you're supposed to file a gift tax return, and that tax on how much you've used up during your lifetime. So when you die, then the amount that you have left applies to the assets that you hold at that time. So again, that threshold is currently 13.61 million. It's indexed for inflation. One of the few good things about inflation is that the index, the amount keeps going up every year. Now, it's gonna, at the end of 2025, this is one of the Trump tax cuts that's set to expire. And that threshold is supposed to go down to what it was in what was that, Hunter, 2020, 2018, yeah, sorry. And it's gonna be somewhere between 6 and 7 million, depending where the indexing is. And that's a sunset provision. So what that means is that if there isn't, if there's no action, then it goes down. It's not that if Congress has to act, the amount goes down. So a lot's hinging on the election right now in terms of what's going to happen with that and some of those other tax cuts. Now, a lot of folks, this is very confusing stuff. It's one of the few, again, there a lot of people know a little bit about this stuff. But a lot of people hear about the annual gift tax exclusion and kind of focus on that. That's the amount that, every time you take your kids or your grandkids out for ice cream, the government doesn't want you to have to report that to them. So they set a threshold that you can give away every year without anybody really caring or having to report it anywhere. And that gets reset every year. So that amounts $18,000 a year. So if I had sufficient money, which I don't, I would give each of you $18,000 in this room. And I could do that, and it wouldn't use up, I wouldn't have to report that anywhere. Because I'm married, I could double that amount. I could give you 36,000 in theory. So again, every year that resets, and that's been adjusted for a while, it was 10,000, and now it's kind of going up a bit. I think it's 18,000 again next year. But again, if you exceed that 18,000 threshold, then you're supposed to file a gift tax return and report the additional amount up to the 13.61. But unless you exceed that 13.61 in a given year plus 18,000, you don't pay any tax. Now, Pennsylvania doesn't have a gift tax. Pennsylvania has a rule that says if you give away an asset and you die within a year, then it's put back on your tax return. So that's kind of a bright line test. I've seen people get kind of stuck on both sides of that rule.
it's meant to design, it's designed so that you couldn't be on your deathbed, and give away all your taxes to avoid the inheritance tax. Now, estate tax, again, is the other side of the coin. It's a 40% tax in excess of your unified credit. The unified credit amount is at 13.61 million, and set to be reduced to 6 to 7 million at the end of 2025. Now, if you're married, and again, any transfers between the husband and wife are exempt. It used to be a rule that if you pass away and you're married, the first person, the husband, so us guys always pass away first, at least on paper, but the husband passes away first, his unified credit amount would just go away if it wasn't used up, if everything just transferred to the wife. So maybe 15 years ago, there's a rule called portability, which allows you to carry that amount over. You have to file a federal estate tax return, but in that situation, they wouldn't punish the wife and say, well, you don't have a lot of complex estate planning stuff. We'll let you carry over the husband's unused amount of credit. You can use it at your death. There are also some special provisions for business owners that if you have an estate that's comprised largely with assets that are business assets, you can defer the payment of the tax over a period of time. It doesn't make it go away, but it's designed to hopefully help you not have to break up that business. Now, that's a pretty complicated calculation. It doesn't happen very often, but it is a good rule. Again, not that any of us like the estate tax, but it is a good rule that keeps businesses from being broken up. Now, there's another tax, the third one I mentioned, called generation skipping tax. I won't get into that too much here, but basically, you're allowed to put a certain amount into a trust and carry that forward generation after generation without it ever being taxed. The generation skipping tax was designed to catch those types of transfers so that the government would be able to tax them. You couldn't avoid the estate tax. So basically, there's an amount you can keep transferring forward without having to pay that generation skipping tax, but anything beyond that is taxable. Now, something that's often forgotten in the mix here are income tax rules when somebody passes away. So there is currently a huge benefit in the form of what we call a step up in basis when somebody passes. So if you have assets that have a low tax basis, you bought a stock for $100 and it's worth $1,000. If you sell that asset, you pay capital gains on it. If you hold that stock until you pass away, or a piece of real estate, you get to step up the basis in the asset to the value of the time that you pass, which eliminates that capital gains tax. So that's a big savings. I get a lot of questions about folks, should I put my kids on the deed for tax purposes? If you're not in federal state tax territory, and if you're looking purely at the tax and not at other things, which may be there, that's usually not a good idea, because if you have a low basis asset, your kids are going to sell it. If you transfer that asset over to your kids while you're living, they're going to take your basis, so that when you die and the kids sell it, they're going to have capital gains. If you held that asset till you die, you get that step up in basis. The kids are going to pay inheritance tax, but that's a 4.5% tax versus the capital gains tax, which is a good bit higher. So that's something to think about in that situation. Now, Pennsylvania inheritance tax. And I don't see anybody sleeping yet, so I'll keep going here a little longer. Spouses are exempt, which again is a good rule. There are exemptions that have been passed in the last, 15 years, I think, for qualified family businesses that are transferred to family members. They have to be below a certain size. Right now, that's 50 full-time equivalent employees and a net book value of less than $5 million. And they have to have been in existence for 5 years at least. Now, you can't claim the exemption on if you say you had an LLC that just all it owned was like marketable securities. You couldn't claim the exemption on that. That would be an investment asset. A lot of times we have if your business is set up, you have your business in one entity and you have the business real estate in a different entity. That's a good way to have things set up. There's a question sort of if your active business is going to be exempt, but is your entity that just holds the real estate exempt? I don't want to end up being cellmates with anybody, but I usually try to claim it just because if you have an active enough management, and the state, I don't think has come out and said you can't do that, but that's a question. That's sort of in the, if you have a spectrum of things with the marketable securities on one side and the active business on another, you're maybe somewhere in the middle here. So I don't see Hunter cringing back there yet, but, now there are exemptions for transfers of farms and farmland. If you transfer, there's an active farming exemption if you transfer it to a family member who's going to keep farming it. There's no inheritance tax on the farm and the buildings. That has to be maintained in the family for 7 years. It can't be rented out to, somebody else. A lot of the folks that own farmland, they don't farm it themselves these days. It's rented out to somebody else who does that. That doesn't count for the active business exemption, but there's another exemption for just transferring farmland. There's no certification requirement, it has to go to a family member. But it doesn't exempt the buildings, it only exempts the farmland. So now what do we do about these taxes? I'm telling a lot of folks right now, and I'm going to run out of good ideas here shortly, is to wait and see, because the election here, we'll know a good bit about what's going to happen. We don't know for sure. If Trump gets in, if I was a betting man, I would say he'd engineer ways to keep tax cuts where they are, including the unified credit at the higher amount. If Kamala gets in, I think she's going to let them expire. I don't think that there's going to be the capital there to make the tax change, but there are a lot of wealthy senators, as you know. So Biden took a run at getting the exemption amounts reduced, I think 2 years ago. And when the Democrats had the House and the Senate, and they still weren't able to get it done, which I think is a good indicator that we have a lot of wealthy senators and congressmen that might like the idea that it doesn't raise that much money, let's keep it higher. A lot of folks other than me probably don't worry about this too much. So now another strategy is get married, because it doubles your unified credit amount. So it's obviously not getting married just because of the estate tax, but there are a lot of benefits for spouses. You effectively pick up another 13.6 million of exemption, which is a pretty big number. Life insurance is a good strategy sometimes. A lot of the stuff that we do with trusts and things gets awfully complicated really fast. All those things have downsides, not the upsides avoiding the tax, but that's a benefit for your children. It's not for you. So you create a lot of headaches with trusts. They do work in many situations, but life insurance is simple. If you can have it structured correctly, there are very good life insurance agents around that can help with that type of thing. Using up the credit before it goes away. And what I mean by that is right now there's about another 6 to 7 million that you have in unified credit that if the cap expires, is going to go down to about half that. Now, a normal person would say, well, I have $8 million. I'm going to give away $2 million right now, and that's going to keep me at that threshold when the tax goes down. Unfortunately, it doesn't quite work that way. The way that it works would be that, say you, in that situation, you had $8 million, gave away $2 million, you'd have, say, $6 million left. If you died after the threshold went down, the IRS would say, well, you have $6 million of assets, you've used $2 million, and so you basically have, $4 million that's exposed. So they would look at the reduced amount. So you can't just give away the amount that gets you to the threshold. You almost have to give away more than what the 6 to 7 million. So if you have 30 million, which I don't, but if you did, you could use that up. If you had 8 or 9 million, it doesn't really make sense. You'd almost have to give away everything you own, put it in trust, or give it to your children to improve your estate tax situation, which is advice I'd not give, because it's okay to look out for number one. There are certain types of trusts. The key with trust when you're just trying to avoid estate taxes, you want to get as close to owning the asset directly as you can without crossing the limit. So you want to name your best friend as trustee if you trust that person. You want to have the ability to make some changes to the trust down the road. A lot of folks will set up a trust for the benefit of their spouse, because as long as they're married, they can still access those funds. So there are some things like that, but they're not perfect. And also note, another reason to not get too carried away with this type of planning is if you say you you go overboard and you transfer $8 million into a trust, then we find out that, the exemption stays where it's at, or the estate tax gets eliminated. Well, you've lost the step up in basis as to those assets you've transferred into the trust. So you've just made your tax situation worse. So point is, it's good to look at this from all angles and not just focus on one side, when you're doing things. So that was a very high level, again, kind of estate tax. I apologize for getting into the subject of death again on a Tuesday morning, but as my dad says, it is something that, at least as long as you're a Pennsylvania resident, most of us will have to deal with someday. Happy to answer any questions anyone has, and appreciate you having me here this morning. Yes, sir.
People with high assets, when you're talking about the 6 billion or whatever, there's a lot for them to think about. The rest of us in the real world that have $87, so what do we have to worry about in the time of death for?
Yeah, so that's a very good question. Primarily, the simpler is usually the better when it comes to an estate plan, not always. So in those cases, we don't really focus that much on tax. There's not a ton you can do to avoid inheritance tax that really makes a lot of sense. You can sometimes give assets away if you don't have low basis assets and you live for a year after that to avoid that tax. But in terms of regular planning, just again, I start with the simplest, kind of work up from there. Do you need trust for any of your kids or grandkids, which you can usually put right into the document? You don't need a standalone trust. So that's a pretty general answer. I'm not sure if but again, not focusing so much on taxes in that situation, more focusing on, who's your executor? Do you need trust for any of your kids or grandkids? Things like that. Yes, sir.
When you were talking about the example of transfer the property to the kids, next thing you know, they're now subject to the capital gains. Another situation there that doesn't often happen, but happens enough that people look back on it, is trying to predict the order of death. And you say to yourself, what the heck, the mom's 80 and the kids are 50. Well, something happens and now, sorry. So I think your advice is very good. The idea of keep it simple, don't try to get so clever that you're predicting the future.
Yeah, no, it's hard for us attorneys not to outsmart ourselves. So that's the nature. But that's very good. That's a very good point. You also, I don't do divorce work, but you transfer to your kids and one of them ends up getting divorced. It's often not the kids, it's the son or daughter-in-law that they see, oh geez, they're not as close to the parent, and all of a sudden they get some ideas, and then you're not in control of your own destiny with your property. So very good point. Yes, sir.
The gift tax and the $18,000 threshold. If I were to give somebody, hypothetically speaking, $25,000, is there a red flag that goes up in the banking system? Or how does anybody know?
That's a very good question. So first of all, if you're married, you would double that. But if you're going just above that, no one would ever really know that much. I'll word this very carefully. I'm not supposed to tell someone you don't need to, if you go $2,000 over your annual gift tax exclusion, I'm not supposed to say you don't need to file a gift tax return, but I mean, are agents from the IRS going to show up and haul you off? I mean, I don't think so. No one would really ever know about that.
So for me to file that gift tax return, is that the person that receives the money that needs to show his income?
No, the person who's making the gift has to file. Sure, good question. Yes, ma'am.
Think of like an information file when you get to an 8609.
That's 709. Yeah, that's the gift tax return. Yep.
So, in regard to that 18,000, if one of the spouses passes away during the calendar year, and the surviving spouse make up the gift of that person?
Yes. Yep, you can do that. You can also do what's called gift splitting with the spouse. So if I wrote a $36,000 check to Hunter, which I'm not going to do, sorry, Hunter, but if I did, I could say that's coming one half from me and one half from my wife. So.
I'm also going to just throw a plug out there. Alex is one in the area that does a really good job as well. Even if we're talking about on the upper side of things, but even as somebody, and maybe some of you guys have young professionals, kids as well. The whole idea of setting things up or having an understanding or making sure you have your ducks in a row, heaven forbid something happens to you as a, you know, caregiving parent. Alex has been very critical in helping us set up things for, you know, in case that proverbial bus hits my wife or me or both of us at the same time and how all that works. So even if it's not necessarily something on the high end with a lot of wealth, even just being able to use somebody like Alex for the peace of mind of understanding of what would happen if something terrible happened to us. That's given us a huge relief. And quite frankly, it's something that we pushed off way too long. And I would certainly, for anybody, definitely be recommending like to look into that stuff very early on, when you do have kids.
Thank you, I appreciate it.
So, sort of in relation to that, in my business, I often say to people when their children go away to college and turn 18 or 21, or whatever the age is that parent, it's probably a good idea if you get healthcare power of attorney for your child, because I experienced it with my own brother and his daughter was in the hospital. They won't give my brother anything because of the kidney loss. Don't send your kid off somewhere.
Sure.
Having some ability.
That's very well said. Yes. Yes, sir, back there.
So as far as primary residence home, my wife and I have two children who are late teens, young adults. Would it be in our interest, you know, because we want to travel more, let's say, if something were to happen to us on a vacation, what would be the benefit of moving things, either adding them to the mortgage or just for tax purposes if something happened to us?
Yeah, so if you're healthy, which you appear to be, and you're, you know,
I know.
So, you know, the tax benefit would be if you put it in their name and you live for a year, they would avoid the inheritance tax, but then they wouldn't get, I'm not sure, you know, your basis in the property, it's not a problem for you and your wife because it's your residence. If you sell it, you get an exemption for, I think it's $500,000 from the capital gains. Now, if you give it to your kids now, you'll save the inheritance tax, but if you have any built-in gain in the property, then they sell it, then they're gonna pay more tax there. So
That's a lot higher.
yeah, and that's a lot higher. So it probably doesn't make sense now. If you were 90, and you knew they were gonna hold, one of your kids was gonna live there and keep it till they died, because it's really only an issue if they sell it after the fact, you know, that you have that, you don't have a realization event to trigger the capital gains unless somebody sells it. So if they're going to keep that asset for their lifetime, then, you know, that capital gains isn't a concern. So that's something else to think of.
But then a question.
Yeah. And it's a good question. And there's often, probate does not equal tax. So, you know, when I say probate, that's the process where you have to go to the register of wills, get your will submitted for the executor to be able to transfer things. That's actually not a difficult process in Pennsylvania, but a lot of assets like retirement accounts, real estate things, if you have beneficiary designations, which is good practice, they avoid probate, they don't avoid tax. But there are some things you can do to avoid probate. You can have what's called a living trust or a revocable trust where you put the asset in there while you're living and then it automatically transfers. That makes it a little bit easier in that situation. But yeah, just having basic documents that control who gets to call the shots there, who's the executor if you and your wife would pass away, you know, that's good to have and pretty easy to do. Yeah. Good. Yes, ma'am.
And on inheritance taxes concerned, are children and stepchildren treated the same way?
They are, yes. Yes, good question. And adopted children the same way. But common law, husband and wife are not that's very difficult to prove. I've had situations where folks have been living together for 20 years, more or less as husband and wife, but they're not married, and one of them passes away, and the other one's going to pay 15% inheritance tax on that because they're not married. So that's it's common law marriage was abolished in Pennsylvania, I think in 2007, and you can still prove it, but it's extremely difficult to do. So I don't think that's an issue for you, but just mentioning it. Yes.
Is it good practice to add beneficiaries to CDs, the bank?
Again, it avoids probate if you have beneficiaries. That makes things go smoother. But I always recommend to people that you have at least some money, some liquidity in your estate to pay taxes, expenses, if you have, real estate, because I've had people do too good.
Attorney to pay the attorney.
Exactly. So, but no, you can usually get around that. Folks can put money back in to pay those expenses, but it usually ends up being more complicated. So if there's enough other cash sitting there to cover the inheritance tax primarily and some, the expenses of keeping a piece of real estate for a while, that having a CD beneficiary designated is a good idea. Yes.
What are your, about taxation of appreciation that they're talking about?
I'm sorry?
They're talking about taxing appreciation of stocks from assets.
Yeah, Commissioner, what do they call that tax when they're talking about the appreciation it's proposed by some, I'm trying to put you on the spot, I thought you might know. No, that's okay. It's
Unrealized capital gain.
Yeah, it's a value-added tax. Yeah.
Isn't it crazy?
That is crazy. Yeah, that's where I don't think that'll ever fly just because I think people would riot. It is out. If you ever want to read something that's a little scary, read some of the proposals. If no parties will be named, but if they get everything passed that they want to, tax-wise, it's pretty extreme. So.
Anyone else?
Okay, I'm gonna pull the mic.
Thank you. Yes.
But before you leave,
There you go.
before you leave, Alex mentioned something about a case of beer on his last day. For some reason, I don't remember that. So I think for two reasons, he probably owes me a case of beer. One, I don't think he really paid up at that last day of work. But for two, because he did work those couple of summers, I think I kind of had some help in you becoming an attorney. Because you probably said, screw this, I don't want to, some son of a bitch, and I'm gonna go off and do it. So I think there are going to be two cases. At any rate, thank you for coming in and speaking to us this morning. We do this with all of our speakers. We actually donate a book to the Goose account.
Okay, great.
So this is going to go into their meeting. I'm going to get you to sign on the board here after our meeting, but Tim, we're going to get a picture of us, just our website. Very good. If we can, let's give Alex a nice round. Obviously, a great presentation on something that we don't always all think about, but at some point in time, obviously could have a big financial impact on our personal lives. So thanks, Alex, and Jeff, thanks for inviting him in to speak to the club. At this point, I'm going to say our meeting is adjourned. Thank you all for being here. Again, just a reminder, next week we have a mystery speaker. We have no clue on what it is, but we definitely need a big room, and I'm sure it will be extremely entertaining, as Jeff is always good at getting us some good speakers. So thank you all. Have a great week. We'll see you next week.